Good morning. Good morning, everyone. I am Maria Dimitriadou. I'm the Special Representative of the World Bank to the UN in Geneva and the WTO. I am delighted to welcome you today in this discussion and to build bridges around financing adaptation and disaster risk reduction. To set the scene a little bit, we know that investing in climate adaptation and disaster risk reduction is crucial, important, urgent, and it's critical to support the most vulnerable people that are hardly hit by climate change. And at the same time, in the current economic outlook and fiscal constraints, it's very difficult for countries to find the resources to finance their climate adaptation and disaster risk reduction agenda. So our intention today is to achieve three goals. Very simple, all of them, but not easy. First, to share our analysis and knowledge on what are we talking about. Why is it important, to invest in climate adaptation and disaster risk reduction? This is the what. Then we are going to discuss what are the socioeconomic benefits of investing in climate adaptation and environmental benefits. So in a nutshell, why is this smart economics, as economists tend to say? And third, also discuss how. How is it done? And for that, with examples, with practices, discussing the challenges, opportunities. And for that, I have an excellent group of panelists with us. Allow me to introduce them. Let me start with our guests. And allow me to start with my esteemed colleague, Ambassador Mai, who is the permanent representative of Vietnam to the UN and WTO in Geneva. Welcome, Ambassador Mai. We have Richard Hardy, who is the investment director in Blue Orchard. Welcome, Richard. Tobias Meyer, who is the Global Key Account Manager for Multilateral Development Banks at Swiss Re. Welcome. Thank you for being with us. Abhilash Panda, Head of Infrastructure Resilience and De-risking Investment at the United Nations Office for Disaster Risk Reduction. No coincidence that Abhilash is sitting next to me because our offices are also very close to each other. And now let me move to my World Bank Group colleagues connected online, and with many thanks for connecting so early in the morning. We have Niels Holm Nielsen. He is the practice manager for the Global Facility for Disaster Risk Reduction and Recovery, GFDRR, as we call it in the bank, at the Urban Resilience and Land Global Practice of the World Bank. Good morning, Niels. And last but not least, my IFC colleague from the private arm of the World Bank, Jan van Bilsen, who is country manager for Austria, the Czech Republic, Germany, Hungary, the Slovak Republic, Switzerland, of course. So thank you all very much for joining us. Some logistics. We do have time for discussion at the last part of the session, and we already have a couple of colleagues who are lined up with very interesting interventions, so thank you very much for that. Let us start with Niels. Niels, the World Bank Group is prioritizing building resilience to climate shocks, and actually this represents nearly half of what we provide as climate financing. And to give you a sense, the total financing for climate in the fiscal year 22 last year reached a record of 31.7 billion. And the facility that you lead, GFDRR, has been doing critical work in scaling the resilience agenda for low and middle income countries. From this experience, can you talk a little bit on what is your analysis on the issue? What are the examples, challenges, and opportunities to crowd in investment in adaptation and disaster risk reduction? Over to you.
Thank you very much, Maria, and good morning to all of you in the room in Geneva, Your Excellencies, dear colleagues, ladies and gentlemen. It's a pleasure for me, first of all, to join you all this morning from Washington. It's a bit early over here. I was planning to be with you in person in the room, but it wasn't possible this time, but I'm happy the technology makes it possible for me to participate, at least virtually. Every month, it seems that we see in the news the impact of climate change related events or disasters, you can call them. Of course, recent floods in Pakistan is on my mind, but major storms, heat waves across much of the world also happens with quite some frequency. We, myself included as professionals, are all aware of the corresponding urgency for disaster-informed investments, and not just to protect what the world has today, but also to future-proof the massive investments needed to meet the demands of growing populations and improve public services and employment opportunities. Indeed, it's costly to delay action. Our research shows that the cost of a decade of inaction from 2020 to 2030 would be about $1 trillion US. And many of us are working hard to address the challenges, and some progress is being made, but much more must be done, and what must be a team effort by all parts of our society. From a multilateral standpoint, as the World Bank is committed to increasing the volume of funding assigned to climate adaptation investments, from flood protection to investing in greener and cooler urban environments. And not just through hard infrastructure, but also through better building regulations and increased use of nature-based solutions, for instance. Under the new Climate Change Action Plan, 35% of World Bank Group's financing will have climate co-benefits, and 50% of the World Bank's climate financing will support adaptation and resilience to help client countries integrate climate considerations into development. We do this, of course, through lending, but also through a wide range of earlier stage activities. As an example, our City Resilience Program, funded by the Swiss and Austrian governments and housed within the World Bank's Global Facility for Disaster Reduction and Recovery, also called the GFDRR, which I manage, helps national and city administrations understand the risks that they face, identify locally appropriate mitigating actions, and critically, in a world of stretched public finance, work on ways to both finance and fund portions of these activities through partnership with the private sector. Indeed, just last week, the World Bank approved a $200 million loan, or credit, if you will, to support an innovative operation in Dar es Salaam to reduce flood risk in the Msimbasi Basin, while bringing economic and social benefits to the local population. And through analysis of local real estate markets and possible private sector partnerships, the City Resilience Program is helping ensure, related to this project, not just the flood mitigation, but also affordable housing, employment, and long-term sustainable operating plan for the riverside parkland that will result from the flood reduction. In Vietnam, a country represented, of course, also here today on the panel, we worked in collaboration with Switzerland's State Secretary for Economic Affairs for over 5 years in the Can Tho Urban Development and Resilience Project. This ambitious investment operation aims to reduce flood risk in the urban area, while at the same time improving connectivity between the center and the new urban growth areas. An investment which will likely increase property values and allow for the city to recover a portion of the investment costs. These types of integrated disaster reduction and urban redevelopment projects are particularly relevant at a time of stretched public finances, as they provide a modality to generate economic activity that can, under the right circumstances, generate a revenue flow to city budgets. Of course, such ideas cannot become reality without a wide range of willing partners, from local population to city officials and critically the private sector. And I'm therefore delighted that we also joined today with a number of private sector representatives. And it's exciting indeed to see the rapid shift in dynamics over recent years, from one of climate change being seen as a safeguarding issue to be overcome, to an increasingly shared interest across public and private partners to incorporate long-term resilience as a core objective of major investments. Indeed, many investors now include explicit mention of climate mitigation and resilience in their mission statements. And this is to be welcome, and what is really a whole team effort. The problem, of course, is that we need to accelerate this alignment of public and private sector interests as quickly as possible. While one side of this will depend on investor strategy, at the World Bank, we remain focused on helping city and national governments provide investable climates, investable project pipelines, and the discovery of new investment opportunities. The challenges are well known. the need for credit-worthy sources of payment, often tricky but particularly difficult at the subnational level, where much of the world's adaptation and resilience needs are located. We also need governments with the technical and financial capacity to identify, develop, and market projects. And of course, we need scale, either through the development of replicable solutions or through other programmatic approaches. I think there's some good news in the sense that some of these challenges can be overcome. For example, in Brazil, where the World Bank Group supported street light replacement program has reached commercial close in 7 intermediate-sized cities, mobilizing a total of 106 million to install 400,000 LED lamps. Another example is in St. Lucia, where the Climate Adaptation Finance Facility is helping borrowers access loans for the purpose of structural retrofit, site stabilization, stormwater management systems, energy efficiency systems, business continuity plans, and more. This facility, implemented by the St. Lucia Development Bank and a component of the government's 75 million disaster vulnerability reduction project, aims to reduce the impact of disasters and reduce the burden on the government to finance housing and business recovery following disaster events. Scaling up this type of approaches, the World Bank and GFGR hope to develop a flexible approach to adaptation financing that can be adapted by other countries and regional financial institutions involving public and private sector entities, and also explore ways to expand access to the more vulnerable and lower income communities. So the challenge to us today is how we can also make this a bigger reality in the field of resilience and adaptation. I think we all have a role to play in this. And I'll end here for now and look forward to the fruitful discussion. Thank you.
Thank you very much, Niels. Abilas, the UN Office for Disaster Risk Reduction sits in the center of the UN system on coordinating, convening activities around disaster risk reduction and towards a more resilient future. So why is it important? Share with us your analysis. Why is working on UNDRR so important and urgent from your perspective?
Great, thanks. Thanks, Maria, first of all, for the invitation, and pleasure to be here with you, Excellency and colleagues. Sorry, I jumped through, right? Sorry. First of all, thanks, Maria, for the question and for the invitation, and it's a pleasure to be here with you, Excellency and colleagues. I mean, after Niels, it's always difficult to try to respond to everything in itself. But as a point of clarification, UNDRR is not an institution that does lending or investment in itself. It's a secretariat agency of the UN, but it has an interesting task. Its primary client are the member states, ministries of finance, ministries of emergency, environment ministries, and what we look at is setting standards and putting in place normative guidances and helping countries in putting in place the right policy instruments that allows governments to be more resilient. At the same time, as we keep on going through this journey of working with the member states, what we constantly see the battle out there is definitely there is a lack of access to financing when it comes to the most vulnerable countries, right? We can call them part of the configuration of low LDCs, or some of the emerging economies, but the issue that they constantly face is there is a siloed approach within how environment ministries look at adaptation versus how the disaster management agencies look at resilience. What we have been trying to struggle and trying to help address this issue is to bring those ministries together. And that's one of the UNDRR's primary focus, is to bring these ministries together so that they can start looking at whether it's a pipeline that they're putting in place on projects or hard assets or non-hard assets, or whether it's a policy instrument that they're putting in place that could get access to financing in itself. Now, the first challenge that we see is most countries, whether we call it the LDCs, the smaller and developing states, or the emerging markets, which predominantly need access to financing, are in a constant cycle of disaster, respond, recover, disaster. There's hardly a chance for them to look at long-term trajectory growth and where investments need to go in. Secondly, what we are also been seeing, and in most cases what is happening, is there's a lack of capacity that governments have in these small economies or emerging markets of what is commercially viable to get access to financing. And what it turns around to is always the challenge of creating a pipeline of projects that allows them to get access to financing or the dependency that they have on the market in itself. During the COVID period, I think we have not come out of it, but just looking at the past, more than 14 countries failed to meet their sovereign debt payments. And it's happening increasingly so. So the market in these economies are not ready for more debt to go in. Interestingly, if you look at or hear the speech of the Prime Minister of Barbados at the UN General Assembly, she called for an overhaul of the financial architecture globally and the need for clauses that take into account disasters caused by natural hazards in the lending streams. Now, is that happening or not? I don't think I'm the right person to answer yet. We have not looked at that evidence base. But there is an outcry that there is high dependency on the market, but the market yet has not built, is not seeing confidence in those investments, and which trajectory takes into an issue of lack of access to financing. Now, whether disaster risk reduction and adaptation economically makes sense, from our opinion, it absolutely does. They are the two sides of the same coin. You cannot be resilient without adapting properly, or you cannot be adapting without being resilient, whether it's investment, whether it's policy decisions, or any of those instruments. We looked at a few countries and in their legislative acts of a few countries to understand, well, is it just an issue of the private market or is it also the public investment? Interestingly, without naming those countries, in most of the LDCs, we are not seeing risk disclosure as a mandatory requirement also from a legislative perspective. Forget the private sector investments, it's also the public sector investments in itself. And that downturn creates trickles down risks to the community level. Because at the end of the day, the businesses are running and communities are surviving in low income communities or at city level, and those decisions are not made at city level. They're made at national, federal level, which still needs to be made. Lastly, and I think Niels has already mentioned the increasing risk. And predominantly, it was always the case of what LDCs or developing economies were facing. But the cyclone and typhoon in Florida as an example, that it's not the developing market just itself. It's also the developed economies which are increasingly facing the brunt of the risks. And the connectivity that we are sitting on, whether be it on supply chain industry, whether be it on businesses, is highly exposed. So the dependency that the developed economy has on the developing market is also creating another risk factor which has not been looked properly in itself. Thank you.
Thank you very much, Abhilash. You already alluded to that, but if you were to select 1-2 key issues that you would like to concentrate on as we look ahead, and ahead you can define how much ahead. What are the key issues, or that you concentrate from UNDRR your focus on?
Sure, I'll give it a try, and I think it's easier if I speak to what we're currently working on with, not just on our own, but also with the UN agencies and with World Bank and other multilateral development banks. Now, the way we see it, there are two aspects. One is the public portfolios, and the other is the private portfolios of investments or decision-making process. Now, I already alluded to it, at the public, from a government level, we see quite a big silo between how national adaptation plans are developed and the national resilience strategies are being developed and being implemented also. There is hardly, the UN Secretary General's call for a 50% investment on climate financing is not being met from any side. So the adaptation financing is already struggling. If you just look at the resilience financing, it's hardly there, and most focus is predominantly around emergency response. And to change that, what we are trying to do is to help with governments understand what are the specific bottlenecks. For instance, we are stress testing the current instrument policies that few countries have in place and identifying what are the specific bottlenecks. And if there was, let's say, X amount of money, where is it exactly you put it now so that you are resilient in the next 6-7 years. The second thing that we are trying to look is to see how can we strengthen the resilience of the corporate world in itself. ESG is one area where a lot of reporting is happening. It has its own pros and cons. I mean, I think the house would be divided if you open up that topic. But does ESG address the need for internalizing risk? We don't think it does adequately, and maybe that's an area where it could be further strengthened. And UNDR is currently working with a few reporting agencies, such as Sustainalytics and others, to see if there's a scope to bring resilience into the dimension of ESG. There has been a lot of debate about mandatory risk disclosure of investment market in itself, the capital market in itself. Whether it's going to happen, we don't know that. But there is a carrot and stick here. If the national regulations come into play and there is a need for mandatory risk disclosure, we could potentially have something in the future. So we are currently working with CVF, the Climate Vulnerable Forum, and the Parliamentary Union to see if in certain countries this could become a regulatory requirement. I mentioned the issue of gap in access to financing. There's another side to that coin, which is, do we understand what exactly is disaster resilience investment or expenditures or adaptation expenditures? UNDP and UNDR has been doing budget reviews in most of the countries. The reason being allocations in budget versus expenditure, they never match. If the allocation could be $100, but at times we just see that $50 has been spent when it comes to expenditure. And there is a huge difference on understanding what exactly is a DRR or disaster risk reduction expenditure versus an adaptation expenditure. So learning from the TCFD process and TNFD process, there is currently an effort to put in place what's a taxonomy for disaster risk reduction and adaptation expenditures or financing, which is predominantly targeted towards countries and their budgeting portfolios, but we hope at some date would also apply on the capital market in itself. Lastly, for the private capital market to actually invest, there is a need for a vehicle for the funds from equity firms and others to go in. And it requires a pipeline that's commercially viable. We don't see that happening in LDCs or smaller and developing states. There could be other reasons. There is a lack of creditworthiness or trust on the governance mechanism. But these are all part of the larger process in itself. Could there be a bond, a resilience bond that addresses some of these issues? Maybe. We don't have an answer to it, but we are working towards it gradually with a group of private capital market actors, but also financial actors. In the short term, what we are trying to do, and this is with Climate Bonds Initiative, we are trying to influence the current green bonds market to bring in resilience into it. So that at least while there is an aspiration to have a resilience bond in the future or a dedicated fund behind it, we will try to see if the current bond market could take resilience into play and invest into it. Thank you.
Thank you very much. Ambassador Mai, let me come to you. Vietnam has been growing steadily for over 2 decades now. But like many countries in the world, climate change is challenging development paths. I have 2 questions for you. One is shorter and one is a little bit longer. Let me start with the first one. Why is it important from your perspective, from the country perspective, to work on climate adaptation and disaster risk reduction? And I know you're already working on that, so tell us a little bit about that.
Thank you, Maria. Good morning, distinguished participants and panelists. So I have the great honor to share with you from the perspective of Vietnam. So as you know that for Vietnam, the need and urgency of the work of climate change adaptation and disaster risk reduction has been recognized and considered as a top priority, vital to our socio-economic life of our people. And this is not only the needs for our own people, socio-economic life, it's also the needs for sustainable development in a world, in an independent world. Yeah. So Vietnam is one of the most vulnerable, one of the countries most vulnerable to negative impacts of climate change. And in Vietnam, we suffer from many severe weather conditions, such as higher temperatures and sea level rise, floods, particularly fresh floods, landslides, saltwater intrusion, and these have been disrupting the livelihood of our people and economic activities and undermining our country's growth. There are various studies and surveys about the impacts of climate change to the life and the economy of Vietnam. And just to give you an example, initial calculations suggest that Vietnam lost about $10 billion in 2020, or 3.2% of its GDP, to climate change impacts. And the estimation also show that without proper adaptation and mitigation measures, it is climate change will cost Vietnam about 12% to 14.5% of GDP a year by 2050, and could plunge off to 1 million people into extreme poverty by 2030, even though Vietnam has managed to eradicate poverty now. So according to the World Resources Institute analysis, the impact of floods on GDP, Vietnam ranked the 4th out of 164 countries surveyed in terms of the seriousness of flood damage to the whole economy. So we see that climate change is more severe to Vietnam, as our country is greatly dependent on agriculture. About 70% of the population living in the rural areas. Most of the poor people live on agriculture and small-scale fisheries along our long coastal line of over 3,200 kilometers. And our agricultural output contribute about 20% of our GDP. So in sum, climate change is considered as an existential threat to Vietnam, especially with regard to the objective of hunger eradication and poverty reduction, the implementation of sustainable development in Vietnam. So what our country has done, our government and our people is determined to adaptation to climate change and reduction of disaster risk. And this determination has been reflected into our socio-economic strategy for the medium term, long term, and annual plan. And our government has promoted cooperation at national level. That means between ministries, agencies, as the panelists already mentioned, stressed the importance of coordination between various national agencies, and also among the provinces and social organizations. Also, we promoted cooperation at regional and international levels for response and adaptation to climate change, disaster risk reduction. And in this, we are thankful to the assistance extended by the World Bank and other international partners, including Switzerland as the host country of various international organizations here. And for implementing our strong commitment expressed by our Prime Minister last year at COP26, in July this year, our government issued the National Strategy on Climate Change till 2050. So this is a very detailed the strategy and focusing on climate change adaptation. Before that, we have the national strategy for the period 2021-2025, have a strong focus on climate change adaptation, environment protection, circular economy, transformation, green finance, and so on, for the objective of promoting sustainable development in Vietnam and for the benefit of the people. So I can give you just the overall objective of the strategy of adaptation to climate change just adopted. One is proactively and effectively adapt, reducing vulnerability and loss and damage due to climate change. And second, reduce greenhouse gas emission to meet the goal of zero net emissions by 2050. And three, take advantage of opportunities from climate change adaptation to transform the growth model, improve resilience and competitiveness of Vietnam industry. This third objective is very much important because given the various challenges and difficulties, if we can mobilize the coordination between various stakeholders and with this, including the private sector in our own country and from international community, we can change the challenges into opportunities so that we can transform the growth model. We can change the economy growth model from the linear economy to circular economy and improve our national competitiveness. So there are only the most recent, these are the most recent policy examples that reflect the determination and strong mindset of our government and our people in the whole of government and whole of system approach to focus on addressing climate change and promoting adaptation to climate change, placing climate change adaptation at the center of socio-economic development policies and decisions. So this is the views from Vietnam I would like to share with you. Thank you.
Thank you, Ambassador Mai. This was excellent, valuable input. Very briefly, from operationalizing your previous strategy and in the process of designing the new strategy and thinking of how it's going to be financed, what are the 1-2 lessons learned that you would like to share with the audience? And I'm very happy that you have shifted from using the word challenges to opportunities, because I already feel more optimistic. So what are 1-2 things that you would like to share with the audience on lessons learned in a non-exhaustive way because of limitations of time?
When it comes to say about lessons learned from the past practice, from my own views, I see that in my country, the role of the government is very important. When it comes to intervention, to have adapt to emergencies and severe disasters, and so our government has early recognized the needs and has early designed the policies and plan for disaster risk reduction, and then climate change response. And now we focus on climate change adaptation and how to change from challenges to opportunities. So that is the most important, and that is one of the important lesson. And the second is enhancing the awareness of the people, of all the system, all the government, the ministry agencies, local governments, and social organizations, and people at the ground, at different localities, to join hands in a comprehensive approach. When we talk about climate change adaptation, we need to understand the comprehensive policy. It is a cross-cutting approach, and it relates to the the life, the consumption methods, the production methods, so on and so forth. So enhancing the awareness is very important, and the engagement of all sector of life, private sector, and in our country, we have huge FDI sectors. How to engage FDI investors in this process is also very important for us. Third is the international cooperation, regional level and global level, and so that we can mobilize the transfer of technology and skill to build our capacity, to build our technological capacity, and also finance solution. So this is my own views. Thank you.
Thank you very much. Tobias, I'm coming to you. You've been waiting patiently. Swiss Re has a long experience in ensuring risks at the country level around the world, including in collaboration with multilateral development banks. And I know you have a lot to say in response to what you've heard already. So what are the key points that you see on financing adaptation and disaster risk reduction from your point of view, from the insurance reinsurance world?
Thank you for having me on this panel. I think it's only fitting, actually, that we first heard from the World Bank and from the UN and now from the ambassador, because the considerations that they make about the impact of such risks, how to address them, how to prepare for them, how to help different stakeholders, countries in particular, quantify them, gain appreciation for their the impact that one should anticipate the next time it happens. All this is work that happens upstream of where my company becomes involved, because a subset of the countries who go through this kind of knowledge building and creating understanding for these risks, some of which are related to climate change, but not all, since seismic risk, for example, is an important one, that is not related to climate change. A subset of those countries, and it's not only an emerging market phenomenon, I should say, decide to put in place a disaster risk financing architecture, let's call it, where they think ex ante, before the next event happens, about how they're going to finance the impact, right? And that requires precisely the type of understanding that Niels is helping to build, and the United Nations is sort of mainstreaming conceptually, that you need to have some sort of understanding, what are these risks that are going to impact me as a country, or perhaps at the subnational level, and to gain an appreciation of fundamentally the relationship between frequency and intensity, right? So how often should I expect a hurricane of a certain category to hit my country? And once you've made that, then some of these countries go through this sophistication process where they put in different instruments, one of them, a typical one being sort of a disaster risk financing fund, which might receive allocations from the national budget every year, and that you can tap into in that year when you get hit and you need, let's call it surge funding or unbudgeted funding, right? Very quickly to do all types of things, to repair public infrastructure, maybe to assist the population that does not have the benefit of insurance or will call on your assistance and so forth. And I want to underline again, this is not only an emerging market phenomenon. In the United States, you have something called the National Flood Insurance Program, right? In this country, in Switzerland, you have a public system for, at the cantonal level, for aggregating risk and sort of defining, for example, mandatory insurances and so forth. And so one of the pieces that some of these countries put in place is that they effectively decide to buy insurance at the sovereign level to complement other sources of funding. And I should say another source of funding, by the way, or another instrument that a lot of these countries use is a contingent loan from the World Bank, right? That you have effectively pre-agreed and then can draw down very quickly when you need it. And insurance at the sovereign level is not, the end or the solution to all your problems. It's rather one source of financing that you then can count on to provide a payout in those instances that you have decided should constitute that triggering event. And this is a phenomenon, if you will, that is perhaps slowly catching on, but it's certainly not, this is not something that governments buy overnight, right? But you do have a consistent sort of trend of more and more countries, particularly with the support of multilaterals, taking this step. And it's a big step because you are now entering or considering entering a market that has its own dynamics, its own pricing dynamics, where you're competing, you as a potential insured, if you will, are competing for finite risk appetite with a very established market. So, Hurricane Ian in Florida has a tremendous impact on prices for this type of risks as far away as Vietnam or elsewhere. And so to make that very calculated step where you effectively transfer a portion of your risk with the intention to create fiscal space that allows you to have access to capital when you need it is something that the multilaterals play a very important role in, and I should say the UN, by creating that understanding, preparing these countries to do that or to consider that step, and then ultimately when they do, Swiss Re as one of the market participants can help them sort of execute what is then a transaction that is not fundamentally different to other insurance transactions, but where the innovation is largely in the fact that you have a first-time buyer, typically a sovereign government, right, placing such risk in the market.
Thank you very much. Excellent points. Looking at good practices, it's a very simple question, but not simple to answer. Looking at good practices and opportunities to scale up, what would you say are the key ingredients to make this happen? What you've seen so far and what you would you hope for, looking forward?
In terms of good practice, the World Bank is at the forefront of this by sort of conceptually designing this idea of a layered risk financing approach where you are aware of how much money you will roughly need given a certain intensity of the event or the perils that affect you in some countries. Think of the Philippines, they have frequent earthquakes, they have frequent typhoons, so it's a multi-peril challenge. In other countries, maybe the United States, it's largely flood that has that type of accumulation potential. And that you then think about, well, where should this money come from that I will need, how much will I need, and where should it come from? And that you design what I refer to as an architecture that isn't just one source of funding, but that has multiple. In terms of best practices, a second consideration is, I think, the reality is that some of the emerging markets will rely on donor support to make this step. There are instances where donors have contributed to the premium payment that is required to transfer risks to the market, sometimes on the condition that the country then budget for that for the next insured period. So in other words, you sort of catalyze it. The reality is also that payouts during the first year or insured period typically help to demonstrate the value added, although I would strongly caution about oversimplifying that, because typically a strong earthquake or a strong typhoon has impact on any country that is far greater than whatever they will collect from the insurance market. So sort of banking on payouts, does not make so much sense, but I do understand that within Ministry of Finance, there's a calculation many times of how much premium am I paying, and then when you get a payout that is larger than that, then it's perceived to have added value. But I do plead for a bit of nuance there, particularly also on the behalf of donors, not to just remain with that calculation, because like I said, actual events tend to be of far greater importance than whatever they will collect from the total of their disaster risk financing architecture, right?
Thank you very much, Tobias. Richard, I'm coming to you. Blue Orchard has been investing in impact investment across continents also for a lot of years, so like 20 years already, if I'm not mistaken. So, and you have an infrastructure to mitigate effects for the most vulnerable post-disaster. Can you share a little bit, and you're working a lot on Africa, so can you share a little bit from your experience, what are the key issues you see from the specific type of work from the private sector perspective?
Thank you, Maria, and thank you for having me here this morning. Yes, so maybe just firstly to set a little bit of context. Blue Orchard is a global impact investor And it's our mission to create lasting and sustainable impact in communities and the environment, while also generating attractive returns for our investors. And in order to achieve this, we raise capital from international investors and development finance institutions, and we use this capital to provide funding to companies in emerging markets that are addressing issues of financial inclusion and climate risk mitigation. So probably the most relevant example is one of our funds, which was set up with the support of KfW, and that's the Insure Resilience Investment Fund. That fund specifically makes investments into companies that are developing weather-linked insurance products in these markets. And so that can be anything from agriculture insurance for small-scale farmers to flood cover for small business owners. Insurance is really key in this area, because the traditional risk-sharing approaches to managing risk or other social security or safety nets aren't adequate for adapting to or coping with the scale of large catastrophes. And so that's really where insurance plays a fundamental role. So in our investee companies, we then provide this capital. We also provide technical support to help these companies develop the insurance infrastructure to be able to distribute these insurance products, particularly to low-income populations. One of the key things really is being able to, when disaster strikes, being able to get payouts into the hands of the insured, efficiently and quickly, and certainly on the insurance side, payouts tend to or are made into the market a lot quicker than disaster relief operations, and so that's one of the key elements. In addition, having this insurance mechanism in place incentivizes further risk mitigation within insured populations, as it helps reduce their premiums. So it drives the right risk sharing behavior. And Tobias touched on described the disaster risk pools that are in place, and certainly alongside the large international insurers and reinsurers, that they play a fundamental role in ensuring that capital is available when a disaster strikes. At Blue Orchard, we see our role, or certainly one of the roles that we play, is developing some of the financial infrastructure further downstream, so that the poor and vulnerable populations aren't left behind. So just one example of the kind of products that are developed within some of our investee companies. The one very common one is parametric agriculture insurance. That's essentially an insurance product that is linked to a particular index, weather index, and when a payment is made to the insured, if that index falls short of or exceeds a predetermined threshold. And because these products are based on an index, what it does is it takes the need for loss assessment out of the claims process, which really accelerates how quickly claims can be paid out, meaning that cash is available when it's most required.
Thank you very much. I have the same question that I asked to Tobias. Looking at good practices and areas to scale up, what are the key ingredients? And you already mentioned a very important one on the downstream infrastructure to reach the most vulnerable. So could you elaborate a little bit further on that?
Yeah, absolutely. So, I think that there are a handful of elements and programs that have been implemented by ourselves and by others in the markets. And the ones that have been the most successful and tend to scale effectively typically have one of the following three characteristics, if not all three of them. So I think, firstly, from a microinsurance perspective, in order to scale effectively, the products need to be simple and easy to understand. Often these products are distributed using mobile phones, and so the traditional insurance model of having an agent or a broker sitting down with a potential client and being able to explain the finer details of an insurance policy just doesn't work in this environment, particularly given the size of the policies that we're talking about. And so, really the key elements of a policy need to be able to be summarized on the screen of a mobile phone. So simplicity is certainly the first one. Then the second one, where really we've seen products being able to scale very quickly, is having the right channel partners. And these local partnerships, again, are really fundamental to the successful launch of microinsurance products. And this can be from a distribution perspective, or it can be from a perspective of being able to bundle a certain insurance policy with other products or services. So one example is one of our investees in Ghana has partnered with the largest mobile network operator in that country, and the mobile network operator has a mobile money platform that has 150,000 mobile money agents that accept deposits, facilitate payments, and pay out withdrawals. And really, by partnering with them, the insurer then has access and reach that without that sort of partnership just would be impossible to create. So really having those partnerships in place are key. And then the third one, which is probably also a type of partnership, is really the role that governments and development finance institutions and other multilateral organizations play in terms of getting a lot of these programs off the ground. We find that, and going back to the agriculture insurance example, is that farmers are willing to pay premiums and are receptive to the idea of insurance, but that in many countries or regions can't afford the full premium that would be required. And so organizations like the World Bank and along with the local governments play a fundamental role in helping to subsidize part of these premiums so that they are affordable for farmers.
Thank you very much. Excellent points. Let me turn to Jan. Jan, our colleague from IFC. IFC has also scaled up climate financing and has contributed not only to the overall achievement of the World Bank Group in allocating its own resources, but also in what we call in the World Bank Group in greening whole economies and also leveraging resources, financing from other resources. Can you talk a little bit about IFC's approach on adaptation specifically in support of the private sector? Over to you.
Yeah, no, thank you very much, and pleasure to be part of the panel. Thank you very much. Indeed, I also had hoped to be there in person, like I was last year when I spoke about demand to supply side of financing in emerging markets. So yes, I'm very pleased to be part of the panel because I do believe strongly that panels like this, sessions like this, and then of course later the COP27, of course, that they basically help to accelerate actions to close the gap on mitigation and adaptation and financing and loss and damage, etc. Just a very quick word on IFC indeed. So we are part of the World Bank group, indeed, as you have mentioned, specifically for the private sector. So we were set up 10 years after the World Bank was set up, so in 1956. We are about, let's say, 1/3 the size of the World Bank, but we have the same mandate as our sister organization, the World Bank, who focus on the public sector to reduce poverty in the world. And that's why climate finance is extremely important because of all kinds of studies that show that, well, with disaster risk is absolutely clear that people are basically thrown back into poverty, and by having indeed the right measurements in place, that you basically develop a country on the right path, right? So that's why we are very much indeed in this. One point that was mentioned earlier. So yes, as IFC, we work exclusively with the private sector. So that means together with private sector partners accomplish our goals to reduce poverty in the world. We work only in emerging markets, about 130, 140 countries in the world. But we also work with governments, but then with the focus clearly towards the private sector. So what does it mean? It means to help governments identify which sectors, what are the opportunities for the private sector to step up in their countries, what is needed for that, what kind of, let's say, regulation, etc. And then we can assist to make some of those changes, the regulations, either ourselves as IFC, or together with our sister, the World Bank, or let's say other groups. So yes, so I think as was mentioned earlier, I think the role of the government is absolutely key. I think that the ambassador mentioned this in particular. I think the political will needs to be there. So what we see as IFC is when we finance across the world, the willingness and the ability and the capacity of the governments needs to be there to create an environment for the private sector to have bankable projects in the country. If the willingness is not there, then basically, yeah, gosh, it's really an uphill battle, right? So increasingly, luckily, we see that the more governments indeed are willing. So what we do as IFC on the climate side, we as World Bank Group, I think Niels mentioned it, we have a target of 35% of all financing by the World Bank Group to be climate related. So as IFC, we invest about $24 billion a year in emerging markets. We are the largest development finance institution for the private sector in emerging markets. So let's say about 1/3 of that indeed is then climate change financing, but climate adaptation up to now is a very small portion of that. So we started counting climate adaptation only in 2013, and in total we have financed only $500 million. So there's only a fraction of what we then finance, let's say, for climate change and climate mitigation and transition, etc. But it is also basically stepping up, and we'll talk a bit about that as well. Now, what we specifically do, let's say for the climate side, we have started issuing bonds already in 2010. We have issued about 180 green bonds to fund ourselves for the on-lending then for projects into emerging markets. We work also with financial institutions. We have about 300 clients for them to do more in climate finance, and a lot of other work is being done. But specifically on climate adaptation, we have invested in a number of projects, as I mentioned. And some of those are, let's say, more in the disruptive technology space. So that means think about agri-tech, to have new technologies and innovation to help basically combat climate adaptation. So, for instance, in the city of Izmir in Turkey last year, is a water utility company. We finance and we help them to upgrade treatment and supply of infrastructure. We've also helped farmers in Nicaragua to replant coffee plantations with more resilient plant species. And another example is an irrigation company that we financed in Africa, in Niger, with systems for more resilient climate-related disasters. So basically for droughts, etc. What we've also done is introduce new instruments. So think about sustainable linked financing. So that means you can identify with the client upfront in the conditions for the loan certain improvements that must, or certain milestones that must be met. And once those are in place, then there is a benefit for the client in terms of reduced interest rate, for the simple reason that once those milestones are met, the risk is perceived to be less. So that then also justifies basically lower interest rate. So that means there is an immediate benefit and indeed an incentive for the client to indeed work on that. Last year we introduced a building resilience index in the Philippines. So this is an index that helps companies to, particularly green building developers, to assess climate risks, but also to identify measures to reduce these risks. And then a final point just to mention is that by 2024, all investments that IFC makes, so as I just mentioned, the long-term financing is about 300, 400 projects for a total of 23 billion around the globe. All of these projects, whether or not they are climate change related or not, need to be assessed and will be assessed on physical climate risk. So let's say climate adaptation issues. So these are just indeed steps what we do at this stage.
Jan, what are the one or two things looking ahead or lessons learned that you would like to share with the audience? And thank you very much for bringing up agriculture, such an important sector and so much affected by adaptation. Do you want to add anything?
Yeah, I would say that, I mean, looking forward, I would say that we are pretty optimistic because we see positive trends. And we also see that, yes, a lot of work needs to be done still. But I mean, as compared to a number of years ago, we see that countries start realizing more. I think it's also mentioned by other speakers as well, that the awareness is indeed increasing, right? And not only at the country level, also of course the public at large, companies as well. And indeed, unfortunately, because of disasters that take place. But I think more in general because of the climate change issues as well. So therefore, that let's say what we see the national determined contributions and also the national adaptation plans by countries are basically in the works, right? So clearly it's work in progress, but those help then also identify basically what needs to be done. And as part of that, also basically countries should conduct, as some do, an assessment of what could be done by the private sector. So in that sense, clearly indeed optimistic. Same for companies. Also companies realize themselves. So not only countries, but also companies themselves, what the risks are and the costs of the risks. So for them, companies themselves, they say, yes, we also want to work more on climate adaptation for their own needs. Indeed is stepping up, and they do see the opportunities to indeed get involved in this. Now, as IFC, and it's one of the points that came up, what is needed for the financing. So as IFC, we act on a commercial basis. That means that our clients are commercial and we finance only bankable projects. So that means there needs to be commercial viability of the project. And at this stage, we notice that many of the projects in terms of climate adaptation need some de-risking element. And luckily, there are parties, we are quite active as IFC involved with them, donors, be it countries or family foundations or etc., who are willing to provide funds to offer a blended financing. So you have the commercial component and the concessional finance component, so together a blended component, to reduce basically the cost and to make sure that the cost of financing is decreased. So that is clearly needed. I think we also see that the labeling of financial instruments, be it green bonds, etc., that gets expanded. We see an increased interest from impact investors to also to go into that space. So it goes a bit to the demand and the supply. So there seems to be clearly ample funds available to finance bankable projects. The challenge really is to get finance to get indeed these projects on a commercial basis. So hence what is needed for that I just mentioned, the de-risking. I think there's also an opportunity to consider to combine some climate adaptation projects with, let's say, climate mitigation projects to make them more bankable indeed as a whole. So that's something that we're looking into as well. But yes, so I'm very optimistic because I think we all see that that it's all moving in the right direction. The technologies are also indeed increasing. We see more public-private partnerships because basically to get this all done, what is needed is that all the parties basically work indeed together. So the governments, the private sector, other institutions, etc. And I think maybe the final point then to say is, which was also mentioned by some of the other speakers, is that increasingly I think the audience, the public, let's say, the companies, the government start realizing it's not only a challenge, it's basically moving from a challenge to an opportunity. And in that sense, I could compare it with, let's say, ESG. Because when ESG all started in IFC, we were a front runner in setting standards like 3 decades ago or so. This was clearly perceived to be, a compliance issue. Gosh, yeah, we need to work on ESG. But now you see more and more, and evidence shows this, that companies who have a good ESG management, if you want, also perform better. So therefore, I'm also optimistic that we will clearly move from the challenges to the opportunities.
Thank you very much, Jan, and also to you and Richard for bringing in, technology. Such an important enabler in all this, in climate action and beyond. Thank you very much. Ambassador Mai, did you have any immediate reactions, or shall I go to Niels to reflect a little bit on what he heard? Did you have something very urgent? Please go ahead.
Yeah. I just want to share with you the challenges that developing countries like Vietnam are facing in terms of enhancing finance for climate change adaptation. So for Vietnam, the financial resources for climate change include 5 main resources. One is the central and local state and local state budgets, and second is official development assistance, and third is the funds to support domestic and international climate change response, and fourth is investment capital from domestic enterprises and foreign invested enterprises, FDI. And the fifth is investment by individuals and households. And Vietnam is facing with challenges with regard to all these 5 sources. The state resources to climate change response have not met the requirement, and due to the capacity, the disbursement of these funds also difficult and slow. And second is the international funding sources tend to decrease, and The nature of cooperation tends to require a more mutually beneficial relationship, and Vietnam's access to international financial funds and participation in international mechanism to mobilize resources to respond to climate change is still limited. And third, resources mobilized from organizations and individuals and businesses to respond to climate change are still very limited compared to the actual needs. The participation of the businesses and communities in many areas of climate change response has not been much, and the potential results in many cases have not been achieved. Investment from private sector is not only limited in quantity, but also lack innovation and technology transfer characteristics. And in Vietnam, we don't have the insurance for disaster risk reduction like this. Attracting private sectors, private participation is key to the next period, and we pay great attention to the following measures. First is to support the private sector for assessing climate change investment, and second is facilitation of the establishment of disaster risk insurance. And in this effort, we are cooperating with the World Bank, the UNDP, and other partners to develop disaster insurance products which are quite new in Vietnam. And third is development of green bonds to mobilize capital for climate change. And fourth is the implementation of complementary solutions to optimize the participation of private sector, and especially to raise the social responsibility of enterprises, effective communication about the benefits that businesses receive from investing in climate change adaptation and integrating climate change adaptation into corporate culture code of conduct. So there are incentives for those businesses engaged in climate change adaptation. So we are looking forward to continue collaboration with our international partners in this effort. Thank you.
Thank you very much. No, it's extremely important to highlight the various resources that are available in the whole. This is a whole of governance, whole of economy, whole of society issue, as it was referred to by all speakers. Thank you, Ambassador. Niels, can I ask you to just take 2 minutes and reflect a little bit on 1-2 issues you would like to, and then we open it for the questions and answers?
Yes,
Sorry
sure. Thanks, Maria. Well, there's a lot of important ideas and very interesting examples that the other panelists have also shared and brought to the conversation. I think from a DRM practitioner, I'm a disaster risk management kind of guy. That's my job and my experience. And from my biased, subjective standpoint, I think often in my type of professional community, we focus on avoided losses. And I think the global discourse around disaster risk management and climate risk management has been very much about avoiding losses for obvious reasons and for good reasons in many cases. But my sense is a bit that to maybe try to achieve a stronger engagement of the private sector, we on our side need to become better at talking about creating value, and not only talking about it, but enabling the creation of value. We heard Jan mention commercial viability. Without creating value, it's often quite complicated to create commercial viability. And there's a lot of work that's involved in that. So I think development finance, public sector folks, typically donors, I would suppose. Sometimes in global conversations, bringing in the private sector to help addressing climate adaptation could seem like a dream of a quick solution. But I think the fact is it's not going to be a quick solution. There's a lot of work that needs to happen to enable that creation of value that is probably fundamental for commercial viability, that will probably be a requirement for any private sector involvement in addressing some of the challenges and taking some of the opportunities that we're talking about. And I think on the beneficiary side, if you will, there are certainly some elements of this that are important for them to take on as well. No, I mean, if you in some places where we work, the private sector is little engaged in other development, and if that's the case, getting them engaged in climate adaptation is going to be equally complicated. And so that means that sometimes it's from a regulatory standpoint, sometimes it's from other decision-making standpoints. It's hard to achieve anything in this space without a strong collaboration between the public and the private side of the equation. So I think going beyond insurance, and it's not to say that you heard that World Bank is quite involved in the insurance market for cat risk. I myself have worked a lot with Swiss Re and others in this space, and we will remain a strong partner in it. But going beyond insurance in the bigger climate adaptation space is going to take a lot of effort moving the needle across the public and the private sphere, lots of upstream work to enable market connections that are not currently happening on their own for a lot of reasons, but maybe principally about this issue of our collective ability to see and create value. Thanks, Maria.
Thank you very much. So we will open for questions and answers. As you're thinking of your questions, feel free to raise your hand. I would like to already give the opportunity to two colleagues who would like to intervene. The first one is Lindsay Jones, my own colleague from the Fragility, Conflict and Violence Group of the World Bank. The bank is working a lot on resilience and in these fragile settings. And, you know, financing climate and climate adaptation in this context takes an extra deliberate effort of understanding risks and financing. In 2 minutes, could you share with us a little bit, Lindsay, what you're doing and you know, what are the key issues in this space? Thank you.
Thank you, Maria. And I mean, from my perspective, really happy to see that a panel focused on adaptation specifically is here. Adaptation is typically considered the kind of the poor younger sibling of mitigation. And that's reflected a lot in some of the, the narratives in the panels over the last few days where net zero and lowering emissions has been, the dominant focus. So really happy to see a focus here on adaptation. And the reason that's important really is that no matter how many, no matter how much we focus on mitigation, over the next few years, we are going to have a lock-in of a significant amount of warming over the next few decades. So we will have to invest huge amounts into adaptation. Very reassured too to hear some of the suggestions and the initiatives going on, from the private sector, from country governments, and from UN and World Bank colleagues as well. We've heard some exciting initiatives. One thing I guess that we didn't touch up on, I would really like to kind of bring attention towards is the unique challenges of raising and scaling adaptation finance in fragile and conflict-affected settings. The reason that's important is that the most vulnerable are typically found in some of these settings, and it's very, very difficult to channel finance to some of these areas, as many of us know. And despite that vulnerability, the level of adaptation finance in particular is very, very low. On a per capita basis, FCV countries receive less than half of the amount of adaptation finance as non-fragile affected low-income countries. So it's a huge gap, and one we really need to tackle. That's something that the IFIs play a huge role in. I know that Tobias, you mentioned that in your talk too. The World Bank and the UN are trying to improve what we do in terms of bringing people together to understand entry points for scaling adaptation finance. In my own team, we're launching a program at the moment called Scaling Adaptation Finance in Fragile Environments. And again, it's trying to bring together climate funds, trying to bring together national governments and the private sector and other stakeholders to really share knowledge on where those entry points might exist. So I'm really hoping that can help us to answer some of these questions and to spur innovation and a renewed emphasis on some of these core challenges that we've discussed today. I guess my core question, to the panelists here, if I may, would be to try and understand where you see some of those entry points. Where are some of the, the exciting new initiatives or potentials for investing in some of these countries where we see fragility, conflict, and violence, really affecting people's ability to adapt to the impacts of climate change. Thank you, Maria.
Thank you. Thank you very much, Lindsay. And the discussion to continue in Geneva. Karim, I'm coming to you. Karim Al-Bayar is the program coordinator of the joint OCHA-UNDP Connecting Business Initiative. I understand you're engaging the private sector around emergencies. So in 2 minutes, could you let us know what you do and your comments on the financing adaptation in DRR?
Absolutely. Thank you, Maria. Thank you, colleagues, for this excellent panel today. It was really interesting and illuminating. As you mentioned, Maria, I'm managing a joint initiative of OCHA, the UN's Office for the Coordination of Humanitarian Affairs, and UNDP, the UN Development Program, and that's the Connecting Business Initiative. We work through our local member networks around the world who are chambers of commerce, business associations, trade federations, private foundations that collectively represent around 300,000 individual businesses, most of which are micro, small, and medium-sized enterprises. CBI member networks, we like to say, are ready and able to coordinate local businesses in preparing for, responding to, and recovering from disasters in their country. And in fact, one of our newest member networks is the Vietnamese Chamber of Commerce and Industry. We're very happy to have them there. And I think they have an interesting example. I mean, I'd like to maybe highlight that role of the MSMEs, specifically around adaptation, disaster risk reduction. As has been highlighted in this panel a few times now, getting access to the financing and the resources can be problematic, and certainly it's very difficult for an MSME as opposed to a large enterprise. In Vietnam, the VCCI, the Vietnamese Chamber of Commerce and Industry, is working with us to do research on agricultural adaptation in order to prepare for the climate change that's ongoing in the Mekong Delta. And they've already identified a number of hazards and ways forward for their member businesses to adapt to the new reality in which we're all living. But as has been mentioned many times, getting access to those kinds of funds, routing them to the small and medium enterprises that in a country like Vietnam represents well over 3/4 of the businesses writ large, is an issue. And I would very much love to hear your thoughts, if there's time as a panel, about how we might improve access to financing and resources for MSMEs, especially in these fragile and conflict-affected countries that we were just talking about. I can also give a number of examples from some of our other member networks around the world, but I know we only have 5 minutes here. I want to make sure that there's enough time to hear from all of you. But I think that the point really is that the MSMEs, given their enormous role in a given country, in the economy of a country, typically over 3/4 of the economy is with the MSMEs. The investment that we make in their ability to adapt, their ability to become more resilient, it promotes long-term sustainability. It's good for their employees, it's good for their suppliers, and it's good for their customers, the beneficiaries of humanitarian aid. So that's a huge area of focus for us. I'm not going to speak for longer than that because I know there's no time, but very much welcome your thoughts on that topic as well. Thank you.
Wonderful. Thank you very much. I know, Abilas, you would like to react, and all other colleagues would like to come in.
Thanks, Maria. I mean, that's a very interesting question you have, and a true case what's happening out there. I mean, from a perspective of where UN comes in, there are almost 20 HPC countries, we call the humanitarian programming countries, and they're all in different situations and level. I mean, near closest example now is Yemen. Yemen is one country which has been predominantly on the humanitarian programming cycle every now and then, and it's indeed very difficult to get access to basic financing needs, forget adaptation financing or resilience financing. There are certain areas of work which the UN largely is trying to look into from a financing perspective, one of which is early action or anticipatory financing action, because that's where we see there is a potential to build the trust of the government, but also at the same time bring the access of basic financing to the community at large. And it has worked in many scenarios or in many configurations. It's still a pilot, I would say. I mean, it has been, anticipatory financing has been out there for the last few years. It's still a pilot, though. There is quite a large interest by the multilateral world and the donor community to make it go big in itself. I would have hoped Pakistan would have been a very good case, but we haven't seen yet how it helped at certain locations. And the other angle we are looking at is, well, you have a financing gap, absolutely. Could the anticipatory financing be a window to it? B, even if you had access to financing, how do you disburse that financing? And that's another big problem in most of the humanitarian countries and fragility context in itself, because in other economies, we could say there is access to P2P financing, peer-to-peer financing happening through mechanisms such as Switzerland has Twin. Other countries have their own. But in fragile countries and conflict countries, we don't see that happening. So we are trying to see what is the level of dependency you can have on social protection systems, existing ones, and how do you retrofit those? Because if there is an existing mechanism, use that for the last mile delivery of those cash. But it's still a debate of meeting immediate needs versus trying to address the long-term needs. Thanks.
Thank you. Shall we take another question, and then I'll turn to you, Tobias and Richard, if you would like to add. Yes, please.
Thank you very much, and thank you for the presentation. Katrin Buchel, Norwegian Refugee Council. It's a follow-up question to what has been discussed. So multilateral actors, they tend to avoid the areas that are most affected by the conflict or by the insecurity levels, and this is where the population is the most vulnerable to climate change events. And the recent research in climate adaptation has shown that, and I understand why. So my question is not about the why, it's about what can be done differently, how MDBs can step up their efforts to actually be able to go to these fragile settings. I will stop here because we don't have enough of time, but yeah, thank you very much.
Thank you. I don't know if my colleagues would like to come in, but I think here I would like to offer a clarification that on the side of the World Bank Group, we don't shy away from investing in this context and on adaptation. It's exactly the contrary, especially through our IDA fund. I don't know if colleagues would like to add, but it's not enough, as big as it is. The point here is that we need to mobilize resources from the private sector, from other resources, widening, improving tax bases. So going back to the points that were mentioned previously, mobilizing all available resources and instruments and innovation. So I don't know if other colleagues would like to come in on the bank side. And then let me turn to you, Tobias and Richard, if you would like to add anything.
I mean, these are daunting challenges that you're trying to address, right? Bring financing to FCV countries. So let's just say that, give it the sort of the importance or the only way, and I'm not in the business of providing financing. We do not lend. My company does not lend money to anyone. But this kind of risk financing approach where you need sometimes called surge funding in certain scenarios to be distributed perhaps by the multilateral community or by the humanitarian community and so forth, that is an area where insurance concepts have been explored. So you may be aware that there was a program, insurance-based, partially, to provide surge funding for pandemic outbreaks. It was actually triggered by COVID-19 and paid out. Received a lot of bad press. I will also tell you that, which makes the private sector shy away a little bit from these type of initiatives. But I'm aware, that humanitarian actors, the World Food Program, the STAR network of NGOs and so forth, have implemented, or the ICRC, by the way, have implemented or have explored this type of idea that rather than ensuring in the populations in those countries or even the local authorities in conflict-affected countries, because there is a reason why finance doesn't flow to that. It's complicated. Who is that contractual counterparty going to be around to pay, to honor the contract, to even receive a payment and so forth? That you kind of transfer this insurance approach, if you will, that I've been trying to explain, to those actors who are going to be in those areas or who want to be in those areas, right? And to simply provide them with the financing that they need when these type of events happen. But I will tell you, that's not the same as insuring against war. We're not insuring against the actual conflicts which create the challenges in these markets. We would be insuring against a risk or a peril that contributes maybe to those complicated contexts like drought, like excess rainfall, like flooding, that type of thing. But not actually the risk of war breaking out or civil disturbance breaking out itself. So there's a nuance there, an important one.
Thank you very much. Any last words, Tobias, before I close? Sorry, Richard. Apologies.
Yeah, I suppose, from a Blue Orchard perspective, maybe it's helpful for us to close on the MSME point, and that really a number of these programs certainly, particularly on the climate side, need quite a lot of help to get off the ground, and that might be government support locally or support from DFIs. But it can also be through technical assistance that we provide through our own funds. But what's clear to us, and certainly a point that I do want to make, is that it's also an attractive opportunity to build these products because they make commercial sense. And often it takes time to get them off the ground, and that's why they need to be nurtured. But ultimately, what we are hoping to do is attract additional capital from the private sector, and grow these opportunities so that ultimately they're self-sustaining in the long run.
Thank you. So I will not repeat everything we have said today because it would be extremely hard to capture, but I leave the room more optimistic, and I'm a very optimistic person, realistically optimistic. I leave with the room with a very long list of issues to continue discussion on. With appreciation for the Building Bridges for offering us this space to discuss. We're very happy that we have contributed very actively for another year. And the last point on partnerships. Geneva ecosystem is an amazing ecosystem. We are here with our partners, our colleagues, and we benefit from that. So this gives me further hope, and the partnerships are central for the World Bank Group, and we very much appreciate your participation in knowledge sharing and pushing the needle further on adaptation through this occasion. Thank you all very much. One last word. I was informed that there is, and we looked into the program as well, that there is another session on adaptation at 4 o'clock, organized by Celsius Pro. Yes? So please join that as well. And a last word of thank you to team reporting on that from the Graduate Institute and all my team in the Geneva office for the brilliant work they do always. Thank you.